So Dale, I noticed, last time we were together was right at the bottom of the miners, and I saw that, you said I'll be long these for a while.
Yes,
Okay,
indeed.
so I don't know if you want to share your screen or not, but
I will, and
okay,
I think I missed you last time, Dale, because I think you were
yeah, you did.
sunning yourself in San Diego or something. I
I
was
made my guess is my internet was down, so I
no,
had to
no.
change providers. So,
I think you were at the beach, but
all right,
anyway, I think I was on with Blake. But as
okay,
you know, I normally do a little presentation, but time was a little bit tight given the fact that I only sort of really realized yesterday that I was doing this today. So instead of a presentation, I will actually. I'm trying to share my
sure.
screen, but it says you cannot
Oh,
start screen
Blake, you
share
have to
while the
unshare,
part's not sharing.
bro. There you go.
Can you? Okay. Can you?
Did you click share screen?
I
Yeah,
did.
or
I
which
did. Hold
screen
on.
you wanted to share?
Yep. Yep. Got it.
There it is. Okay. Real
Okay. So.
GDP.
Okay. So. Can you see that?
Yeah. Yep.
Perfect. Okay. So. Um. I guess people that would have listened the last few times that I've been on would realize that I'm a very old and long in the tooth ex-prop trader and hedge fund manager, having worked for some of the big investment banks and run various hedge funds during my 37-year career now. So I use what's called a techno-quantamental approach to markets, which combines my global macro background. I started out in the 80s as a sort of fixed income and currency trader at Lehman Brothers before I moved into quant equity. So the mental of the techno-quantamental is obviously the fundamental background. So I'm going to start by just giving a brief overview of where I think we're at. And as you probably will remember from last time I was on, and I think it was quite apropos that Blake mentioned it, I think earlier on, we are in a Goldilocks environment. And I don't see any obvious signs of recession or inflation coming down. And this is where we're at. Real GDP is still growing around 3%. Okay. This is a completely normal environment. Jobs
Okay.
are still growing.
Okay.
Average hourly earnings still growing, just in the same range that they've been in for the last goodness knows how many years. Retail sales still growing 3, 4, 5%. Consumer sentiment it's come off the lows from 2022 and it's heading upwards. Inflation expectation, University of Michigan inflation expectations again bottomed around 2020 and is now heading up. And my favorite one, which I always sort of fall back on, is the long-term CPI. Okay, people say you can't chart fundamentals. Well, I completely disagree. And you can look back at this going back 50 years now as to where inflation has been and where it's going to. So in my
Looks like an
view,
important area there, Dale.
yeah, absolutely. So I think I likened this last time I was on to a beach ball that you can hold underwater for a while, but
Yeah.
eventually, it pops up. And this is what we've got now. The Fed have maintained very easy money for such a long period of time that there is now way too much excess capital in the system. Interest rates have been too low for at least a decade. And this is what we're seeing now. Yeah, COVID was, a one-off and a driver of the spike that we saw back in 2021, 22. But this is not going away. Now you've let the genie out of the bottle. This is not going away. And 2.5% is kind of
A
where
floor.
we're at. Yeah, it's a floor. So it was a resistance, and now it's floor. So I've even done some Elliott wave on this. So, you can see it's a very nice Elliott wave APC pattern. And now we're either going to get an APC higher or,
Yeah.
and this is my fear, that this turns into a wave 3 and we enter into a phase of, potentially hyperinflation in the years to come. And I've said this now for the last 4 years.
Well, price controls ought to do that.
Yes, I'm not. Yeah, I'm not going to prognosticate on what domestic policy is going to be, but I do believe that we are in a and I've said it now for 4 years. We are in the early stages of a generational bull market for inflation, and read into that what you will, but position yourself accordingly. So, on the back of that, I am looking for assets that are going to be positively impacted by higher inflation, and I'm looking to short assets that are going to be impacted by interest rates, which over time will be much higher for much longer than people think. And
okay,
yes,
well, what do you think? But lower first. I mean, we've had a hell of a
yes,
move in the bond market, and
yeah, exactly.
I still don't see any reason to short it here yet.
No, absolutely. So this is where we're at in terms of 10-year yields. And you might notice that, I'm not a short-term trader like, a lot of you guys are. Obviously, when I'm executing trades on a day-to-day basis, we obviously take care of what the levels are. But I think it's always important, especially when you do what I do, that you take a step back and you look at the big picture. So this is where I think we're at in terms of 10-year yields. Anybody that's familiar with technical analysis, and I think Blake alluded to this maybe last week, I think I was listening to the show last week, head and shoulders patterns are reversal patterns. And I think what we're seeing here, not only in bonds, but in another number of other markets that I'll come on to shortly, is I think you're beginning to see an inverse head and shoulders forming, which means that we could easily see slightly lower rates over the coming, and don't forget, 3 to 6 months potentially. But that
3% yield.
3.25 to 3.5 is where I think we're going to go to.
Okay. All right.
And then I think we're off again at some point. Now, what the driver of that is going to be, I don't know, because the Fed are about to embark on a rate cutting cycle, which I think is completely misguided and inappropriate. And my view on the Fed. Don't get me started on central bankers. It's one of my pet hates. But you're right in terms of where bonds are right now. We went long TLT back on June the 3rd at 90.80 with a target of 100. We're still riding that trade. It could even go a little bit higher. It could get up to about 109. But in that 100 to 110 range is where I think we're at. So we're in a
bear market rally. Some people are calling this wave 4, Dale.
Yeah.
That when this rally's over, it's 4, which implies what you're talking about for higher yields.
Yeah, exactly, which is what I've got here.
I wanted to ask you, in the last 6 months or so, even more shorter term, the move by a lot of big funds, and means they kind of have the same feeling as you do. They're really buying risk off stuff. They're buying staples, consumer staples. They're buying bonds. They're buying gold. They're buying healthcare. All these are kind of risk off, defensive type of positions, which have outperformed the S&Ps by quite a bit. So is this really kind of a foreshadowing? These guys can't do it all at once, but they're starting to shift positions to take advantage of exactly what you're talking about.
No, I don't think so. I think the outperformance of the defensives in, I would say, the last 6 to 8 weeks has primarily been driven by the sell-off that we've had in risk assets, and it's just profit taking to a large degree. But maybe if I just come on to a couple of other points, Dale, and you'll sort of see where I'm headed to.
I can listen.
So I hope so. Don't go to sleep though. So so what is the rest of the macro picture before we get on to some specifics? Okay, well, I think the last time I was on, I was talking about the US German 10-year yield spread, which broke out and then had a false breakout and has now come back down. So when this spread moves higher, it means a stronger dollar, and when the spread is coming down, it means a weaker dollar. And that's kind of where I think we're at right now, a weaker dollar, at least in the next probably a number of weeks, maybe a few months. And what does that mean for the dollar? It means probably headed down towards, maybe mid to low 90s. And what does that mean? Well, that means it's beneficial for stocks because rates are coming lower, the dollar's getting weaker. And I don't see anything at the moment which would indicate to me that we're in a risk-off environment. Every single picture that I look at in terms of equities especially, but also other risk assets, and we can come on to that, is indicating higher. And all we're saying is we're just saying minor corrections. You cannot stand in the way of this. I mean, I don't know specifically whether I would call this a Goldilocks environment, but if you're in a phase now where the Fed are going to, again, mistakenly, I would say, start cutting rates, and the dollar's going to weaken as well, then I don't see, and the economy is fine, I don't see any reason why you would want to get in the way of risk assets. So for me, I made a lot of money in my career being short, and that's hence my nickname is DB Noble, right? But you cannot fight a trend, and you have to trade what you see. So all of this is the momentum factor ETF. So those are the S&P futures headed higher, momentum headed higher. The DAX, very small pullbacks and still headed higher. This is the ETF for broker dealers, and you can see broker dealers make money. Yeah, broker dealers are making money. The markets are going higher. You don't see broker dealers outperforming when stocks are getting battered, right? Semiconductors, everybody's getting negative on semiconductors. I don't see it. I don't see it. We are still in, if I look really long term, going back, 12, 14 years on this could easily still be a wave 3 of 3, which means that you've got substantially higher to go. There's nothing, this is Russell 1000 growth over value. And when this is going higher, it's a risk on environment. If I look at commodities,
are you impressed by Russell's recovery? I mean,
yeah,
what it gave back from that big, huge day,
yeah,
was one hell of a negated a lot of stuff.
To be honest, Dale, up until about 2 months ago, actually even till towards the end of Q2, we were short, or I was short in the portfolios of small caps because it was the obvious trade. But now the Fed have indicated they are likely to embark on a rate cutting cycle, however misguided and however short that may be. It means that small caps will begin to, in my opinion, outperform. And I actually did post about this on Twitter. I'm just thinking if I could see it. This is QQQ. So this is basically the Qs over IWM, small cap, going back 20 odd years since the rally started in 02, right? So if you look from an Elliott wave perspective, we called this, we were looking for this pink box up here as the target. Didn't quite get there, but then I posted, I think it was round about here when we had this big down week, and I said, this is kind of getting close to where we're looking for now. We could be in the start of a correction, which means that small caps are going to outperform. And that's the sort of thing that you would expect if rates are coming lower, because that small caps have been struggling because of the fact that rates have been going higher, right? And their balance sheets are just not as robust as larger companies. So that was an obvious trade. But let's just come back a second. All of these things, all these different things are suggesting to me that we are still in a bull market and risk on. So that's a CRB. Okay. So we were talking about gold earlier on. I have a slightly different count to Gregor. I think we're going much higher. Same for silver, slightly different count, maybe not quite as bullish. And that brings me on to the miners. You pointed out we have been bullish now for quite a while on mining stocks. And my favorite chart of all, because we look at everything on a relative basis, right? Because when we run long short, we always have to be short something against something that we're long, because we run basically market neutral books on the long short side. We look at everything versus the S&P.
Yeah.
This looks like it's going higher, but my favorite chart is GDX, because if I look at GDX versus the SPY, not only is it a perfect Elliott wave count on the way up here, it's hit resistance, it's pulled back to 50%, which is ideal because we always look for a 56% pullback, and it's also forming an inverse head and shoulders, and it looks now like it's ready to go. And I posted a few weeks ago saying, I think we're going much higher. I mean, I think 30 to 40% higher over the next several months. And these are some of the stocks we've been in. This is Alamos. This is AGI. Sorry, Aya.
Dale?
Yes.
I have a hard appointment in 5 minutes, so Blake's gonna take over and wrap up the interview. I want to.
I'm here. Yep.
I want to thank you, and we'll catch you. I'll get a hold of you on Indeed. LinkedIn, and we'll set up another date. Okay?
Yeah, absolutely, no problem.
Dale. Great hearing your voice. Congratulations on your excellent trading.
Thank you,
Blake.
Dale.
Yep. I'm here. Good morning, Dale. I'm back. I'm here. So anyway, so you were telling us these are some of the stocks that are following GDX.
Yeah. So Alamos and Aya are two of the gold stocks that we've had on board, and we still like those.
So why have the miners really underperformed gold? What would be your analysis and the reasons why?
What typically tends to happen in bullish markets is that everybody migrates to stuff that's going to fly, so high beta stocks.
Sure.
And when you're trying to compete against that, it's hard. So gold stocks find it hard to compete against the super high beta stocks when things are going well. I would say what's the tailwind now is that with a falling dollar, and rates being lowered by the Fed and being in a sort of stable interest rate environment on the long end for the next several months, I think this is a perfect environment now for metals and miners. But it's not just metals and miners. I mean, we run a very diverse book, as you probably remember. We believe in running very big books with lots of different positions in them, and gold miners are one of our favorites. I have to say they've done very well for us, but not just gold miners. This is Carpenter Technology. We've been long with this. This is a specialty metals and minerals company that does a lot of stuff in alloys. We've been along a lot of biotech stocks. So this is Vera Therapeutics. This is Viking, Verona. All these stocks, are going through huge bull runs. That's Tango. This is Janux. So it's not just metals and miners. That there's a lot of stuff going on beneath the hood in markets that you have to really you need to dig down and find out what's moving, what's driving it. And this comes back to something that I've used in the presentations before, which is I have this phrase, which is depth. You won't survive in markets, or you won't perform well in markets unless you have depth, which is diversification. Einstein, which is basically time, know your time frame. Probability, so understand that you'll be wrong some of the time, and I've done a lot of trades over my career, and historically I'm right about 60 to 65% of the time, but I still do pretty well. But understand that you're going to be wrong some of the time. And then T, which is, I was going to have two P's, but I put a T in there to match the acronym. So T is thorough process. So you have to have a process. It has to be a repeatable process. So don't go jumping from one strategy to the next just because yours is not working for 5 minutes, right? You have to stick with what you know, stick with the process, and then have some humility and just be aware that markets don't always give you what you want. Markets will give you what they want to give you in the time frame that they want to give it to you in, and that means that you have to have some patience as well. So just to follow up, we don't really see anything that's that's really bearish in markets right now. This is something else that we're kind of keeping an eye on, and sort of dabbling our toe in the water here. This is the Golden Dragon China Index. So we think China stocks, I mean, China's economy is not is not doing great right now, but this to me looks like another inverted head and shoulders with a perfect wave one up and a very long wave two consolidation, just to shake everybody out that doesn't have the patience to stay in a trade. So China internet stocks are, I think, one of the prime candidates for a big move.
Really?
Yeah, and I think,
I mean, and they've been beat up so badly,
yep.
but I'm interested to hear what your reasoning is at this point.
Because I think that if we are in an environment, which I think we are, of, you know, you've coined it, quasi Goldilocks, right?
Yeah.
With the economy actually doing okay over here, and don't forget that the US market drives pretty much everything in terms of risk appetite. Yes, China
Sure.
is a very special place, and I've done a lot of work in China. We've worked with a number of China hedge funds and allocated to China hedge funds over the last 15 years, so we know the space relatively well. I think in a risk on environment, in a Goldilocks environment, investors will migrate to anything which has big upside. They won't want to be in stocks that are going to make them 10 to 15% a year. They'll want to be in stocks that can make them 100%, right? It's
Right.
just human nature. And so when you get big stocks like Alibaba that's been beaten down and lost, 80% of its value since its peak in 2021, there is going to be some fishing around for bottoms.
Yep.
And if I
Bottom
look at
fishing, and I mean, if you really don't think Baba's going anywhere, I mean, AliExpress and Baba probably aren't going anywhere. They're like an Amazon of China. So why not buy them at this discount, right?
look, it's still a $200 billion company. So this is not a small stock. This is a major stock.
Yeah.
It's a reflection of the broader China economy, and the Chinese economy. If you take a long-term view, the Chinese economy is going to be the biggest economy in the world in the next 10 to 20 years. And so if you have a long-term view, whether you're a pension fund or an insurer, you have to be allocating to China. And so if you're going to do that, you probably want to be in bigger stocks rather than smaller stocks, because there's less career risk in doing that. And Alibaba is an obvious name. I think they've got earnings coming up this week. I'm not sure exactly what day it is. It was actually last week. So
yeah, I'm not sure.
So I think Baba, JD, these are sorts of names that you want to be looking to maybe own for a pop of some variety. Don't forget timeframes though. Our timeframes, or my time frame, is usually much longer than probably the people that are listening to your show. So don't think that I'm telling you to go out and buy it today or for the next 5 minutes, right? And then, just finally coming on, this is another reason why I don't think I can be bearish right now. All we're seeing is pullbacks to moving averages or to trend lines or to, channel supports. So this is semiconductors against the SPY. So that means, semi stocks haven't finished yet. Here's Nvidia. Nvidia's earnings, by the way, are next Wednesday. Here's Taiwan.
They are. Thank you.
Taiwan Semi. ASML. We're not seeing anything that gives us cause for concern right now in terms of an equity bear market. And believe me, I would love to see an equity bear market because I make a lot of money in bear markets. But you have to trade what's in front of you. And right now, what's in front of me, what I see, is again, we'll come back to the Goldilocks. Maybe it's Goldilocks, maybe it's not Goldilocks, but it's not bearish. So there's other stuff that we could sort of point to, but I think that's kind of the message that I wanted to get across.
I appreciate it, and the thing is I'm having a hard time being bearish as well. But I want to get your view here. How much? Because I believe it all hinges on Friday. It all hinges on, and I don't know exactly where the appetite for the market is. My assumption is the market wants and needs a dovish Fed, and I think he needs to kick the door wide open for, you know, a 50 base, whether we get it or not in September, which I don't think we're going to get. We need to have this week, we need to have the idea that 50 is possible, even though I don't think they're going to deliver it. But that's what I think the market needs. Do you feel any differently about this week?
I don't think it's going to make a huge amount of difference, if I'm honest, just because of the fact that markets are in the frame of mind now that rates will be cut and that we are at the start of a rate cutting cycle. Now, how long that lasts and how many cuts there are, who knows? Again, I'll say it again. I think it's misguided longer term. I think it's the wrong move, and I think it's going to reignite inflation in an economy which is not doing that badly. So I would be surprised if it was 50. Yeah, a little bit surprised. I wouldn't be totally surprised, because I think if you believe that the Fed is independent and non-biased, I think that's a very naive view of the world. I do believe there is some bias in that. So I do think, and I'm a Brit, so I have no view on American politics, so I'm not even going to go there. But I think you're coming into a presidential election period, and I think the Fed are going to try and do their best to make things look a little bit rosier in the garden. So nothing would totally surprise me, but I think he's more likely to go with 25 and then, leave the door open for more to come. And I think as long as markets think there are more to come, then I think, risk on, right?
I can't disagree with you.
At the point where he says, actually, one and done, I think that would send the markets into a bit of a tailspin, because nobody is expecting that. So he says, yeah, we're going to do 50, but then we're going to hang up our boots for the next 6 months and see what happens. That I think is potential for lots of red on the screens, but I don't see that either.
Well, Dale, it's wonderful having you here. I was searching for you a couple weeks back, and I'm like, how come I don't see Flash 360 on this? I didn't see on Twitter anymore, and I'm like,
no.
But you know what? It's nice to have you here. I did get your email. I got it from Stelios earlier while you were speaking. I am going to shoot you an email, and if the offer is still open to spending a little one-on-one time with one of our listeners, sometime this fall, we'd appreciate it, and I'm sure one of our listeners would really enjoy the opportunity.
No, I'm very happy to do that. I said before, I really appreciate you guys and what you do for the wider or the broader community, and you put a lot of effort in over the years. So I feel it's the least I can do to also, help you guys out and your subscribers.
Awesome. Well, it will be, just so everybody knows, it's going to end up being a giveaway, and it will be a lottery, because not everybody's going to get an opportunity to spend some time with Mr. Briscoe. But if you're the lucky winner, you better count your lucky stars, because it's nice being able to talk to you, Dale, one-on-one. It really is. So, Dale, thank you so much. Keep up the good fight, and good luck this week through Jackson Hole.
Yeah, I'm so long in the tooth now, Blake, that nothing ever phases me now. I'm at a point in my career where I'm very, very happy with what I do and how I do it. I can sleep at night. We run the book so that we don't really care too much one way or the other. Long gone are the days where, back in the late 80s and 90s, where I used to be trading, currencies in the middle of the night, having the Tokyo guys call us up about, the latest 50-point move in dollar yen. So I don't get that anymore. So I'm very relaxed about life. So there's nothing that JP can do at Jackson Hole which is gonna upset the apple cart.
It's funny. When I switched prop firms from the Florida firm over to Greenwich, and I met with Mr. Gellos, and I was at his house, and he lives on this huge estate in Connecticut, or used to. He actually sold that and moved closer to downtown anyway. And he had set up, mind you, he's in his late 60s, maybe early 70s at this point. But he had his screens above his guest bedroom bed. Like, so when you're sitting in bed, you can be laying in bed on your back and seeing screens. And he's like, well, it's life of a currency trader. And I'm looking at that going, damn, that's hardcore. So at least you're past those days.
Yeah, no, I can remember the days where we used to have little Reuters pages and Telerate pages, to take home with us from the office back in the 80s. Talking about back in the 80s now, this is when we had regular days where you'd see dollar mark, as it was in those days, not euro dollar.
Yeah.
Where dollar mark would trade like 5 or 6 big figures in a day, and you had to take a page home with you, because I've got a very funny story. One day when I think it was after a set of trade figures, or maybe it was the employment figures, and I was trading OTC FX options on the desk at Lehman at the time, and I was trying to gamma hedge one of the options that I just traded with a counterparty, and I shouted at my dollar mark trade. I said, where is it? And he says it's 2070 on the wide, and I said, what's the big figure? And he said, I don't know. I'll have to get back to you.
That's so crazy.
Yeah.
I can imagine the wild moves. Well, anyway, guys, just Dale's not on X anymore. But it's wonderful to have you here, Dale. We'll I know Dale Pinkert will be reaching out to you via email. I'm going to be reaching out to you, and I'll coordinate something with you this fall myself. And thanks for being here with us. Really appreciate you, sir.
Yeah, no, my pleasure. And say hi to Stelios for me. He's an ex-Imperial guy, just like myself, and he's a good guy.
I will. I'll message him that here momentarily. So thanks, Dale. Have a great one, and thanks everybody for listening in. Remember, tomorrow Canadian CPI right here on the Face Show. I'm gonna wrap us up, and thank you, Dale. Thank you all of our guests for being here, and we'll see you tomorrow. All right. Cheers, Dale. Hey traders, this is Blake Morrow with Forex Analytix. Thanks for stopping by our YouTube channel. Don't forget to like these videos, share them, and subscribe to our channel so you don't miss any of the content that we provide here for free. Thanks for stopping by. I'll see you in the next video.